Hello everyone, I am Hock An Lee from Labuan Faculty of International Finance, University Malaysia, Sabah. Today, I would like to share with you my research on the developments of Malaysia Financial Condition Index, FCI. This index provides a comprehensive view of the financial development or financial stability in Malaysia by showing that whether the conditions are tightening or easing. So in Malaysia, most existing studies focus on monetary conditions, and my research expand that perspective by constructing a composite FCI that bring together the data from multiple financial markets. Let's begin with the banking system. This component reflect domestic credits and liquidity conditions. And under this component, we examine three key indicators: the 3-month CRIBOR minus 3-month Treasury bills, and the second indicator is average lending rate minus 10-year Malaysian government securities, and the third indicator is broad money M3. So under this component, when credit spread widen or lending rates rises, it signals that financial conditions are tightening, so making borrowing more expensive for households and businesses. The second key component of the FCI is foreign exchange. So this component measures the external resilience. So under this component, we include three indicators. So the first indicator is real effective exchange rate. The second indicator is exchange rate volatility. And the third indicator is international reserve. So a stronger ringgit and higher reserve indicate confidence and stability, while sharp volatility can point to uncertainty in global markets. The next component is bond markets, which reflect funding costs and investor confidence. So under this component, we track short-term yields, for example, the 3-month Treasury bills, long-term yield like the 10-year Malaysian government securities, and the surveillance spread between the Malaysian 10-year government securities and the US Treasury notes. So when the spread widen, investors demand higher compensation for risk, which is a signal of tightening financial conditions. And the fourth component is equity markets. So equity markets will look into the investor sentiments and market liquidity. So under this component, we use three indicators: the KLCI index, intra-month KLCI volatility, and the market capitalizations. So under this component, when stock prices rise and capitalization expands, it points to easing financial conditions. However, when volatility spikes, it reflects market stress and investor cautions. Finally, the fifth component is the property markets. So the property market actually link between the financial sector and the real economy. So under this component, we track the house price index and the volatility of the house price index and the Kuala Lumpur property index. So if the index under these components are stable and rising house price suggests confidence and the wealth growth, whereas sharp volatility or fluctuations may indicate speculative risk and market imbalance. Okay, so these are the 5 key components that help us to construct a financial conditions index. And then at the end, we are going to bring together, and all the 5 components are statistically transformed and combined into a single financial condition index. So this financial condition index provides a timely, data-driven view of financial health or financial stability in Malaysia. So in other words, the financial condition index can be used to serve as an early warning tool for potential financial stress and a valuable guide for policymakers, analysts, and also investors. So I hope that this financial condition index can contribute towards stronger financial stability and policy insight for Malaysia. And the index is jointly developed by Yiling Pang, Hui Hui Lee, and myself. And thank you for watching.